We also work with some of the big five banks on some of their alternative mortgage desks, and if they have a banking client who's unable to get a mortgage with them for a period of time for whatever reason, then they would contact a group like ours to place their client with us for a period of a year or however long they need.
Rob?
Yeah, I'd say in Toronto, about 85% of our book is direct relationship with the developer. You get much better information, and you develop a relationship with them. So repeat borrowing is much more common if you do that. If you go through a broker, unless you're the low-cost provider, the next time you're not going to see that client again. In Vancouver, it's a more heavily brokered area, so I would say we're probably 2/3 direct and 1/3 brokered, which is pretty good. And there we try to focus actually with a few small, well-connected brokers so that, and I was a broker after I left. I ran Royal Trust Real Estate Lending Group for Canada from 90 to 93, and from 94 to 97, I did brokerage. And I was basically a one-man operation. And when you're a one-man operation, you're not going out to a million different lenders. You have your favorite lenders just to make your life easy and get on to the next deal. So we're trying to do that in Vancouver, where we're very valuable to a few well-connected brokers.
How do you become a favorite lender? Is it speed? What is it?
It's speed and creativity.
Okay.
Yeah, I would say in our space, it's a bit different since we're working with brokers who work with individuals who are buying homes. It's certainty of closing. So if you commit on a loan, as a lender, you need to fund that loan, and speed to close as well.
Yeah, same here. I mean, we have a philosophy in our office that basically we like to open the file and close it within a week if possible, and no more than a couple weeks if it's a bigger loan.
Okay, great. So bridging has been a big topic over the last year, I would say. Has it, even though it's in a different space, it's private debt, and I'm sure you're dealing with a lot of the same sort of money managers with your clients, has it had an effect on this space, on your space?
So for getting back to what Lisa's original point very early on, it's impacting obviously the syndicated mortgage market, because once there's a blow up like that, plus a few other funds as well, everyone gets painted with the same brush, if you will. That being said, we've actually seen we went under the hood on bridging itself. It's a different loan portfolio by a country mile. I had one distressed bond investor who said when he looked at the portfolio, a very well-known distressed bond investor who said, quote unquote, if I get 3 cents on the dollar on this, I'd be lucky. So I wouldn't characterize ourselves with the same brush, but as they say, perception is reality. So you do get painted with that brush as everyone being in the alternative space. But remember, the vast majority of the underlying investments that bridging had done, with the exception of 1 or 2 loans, were in fact non-real estate related, and they were just weird pieces of assets that nobody could understand. Mm-hmm. So hence the 3 cents.
Yeah, Rob, was there any effect?
So we have a small high yield MIC that we started, and we did a cash call shortly after the bridging articles came out, and it went fine. But I think it's partly because I'm one of the 3 largest investors, and 2 major developers are the other 2 of the 3 largest investors. They're also on the investment committee. So I think there was a real, and most of we only have 40 shareholders because it's only a $60 million fund at this time. And most are very familiar with real estate and very familiar with who's running it and who the investment committee is. So we didn't have any problem. But I wondered if it was going to happen.
Yeah, we sort of wondered as well. And so our response was to send out a letter to our investors as quickly as we could, just to sort of call any fears that they would have. We try to maintain open dialogue with as many of our investors as we can and give them as much transparency as they would like. I think in response to that bridging letter, we had one investor who asked us to see our loan tape, and so we scrubbed a loan tape and sent it to them, and we're totally happy to do so. The one industry impact that I did see right out of the gate was some of the independent asset managers did have a moratorium of accepting new private credit products onto their platform. So that's something that has impacted the space, but I think that's really the biggest impact that I've seen.
Okay, thanks. So I'd like to, or have Karen, open up the floor to any questions that you may have for the panel.
Does anyone have questions? No questions.
There you go.
Oh, sorry.
I don't need the microphone.
Who is it?
Just the comment that you made about you were making it, Sandy, about the acceptance of mortgage lending. The bank gatekeepers seem to pride themselves on, too many bank people in the room, seem to pride themselves on the fact that they are adding no, illiquid, risky private lending mortgage funds onto the platform. And we've already heard today, we're in the worst 21-month period for Canadian bonds in 45 years. So I'm buying a 10 NAV and I'm making 6-7% yield versus buying something that's going down by 10%, getting paid 1.5%, and somehow the latter is less risky than the former. Have you talked within your mortgage industry about getting greater regulatory acceptance and sort of risk ratings and bringing mortgage lending into more Canadians' hands to actually address this risk?
So short answer is no, but I don't disagree with you that it's something that a conversation needs to happen with the banks as to people being able to borrow a lot, or investing in the alternative space a lot more than they currently do. I mean, let's put mortgage lending aside for a second. What have been the biggest alternative investing space in the last 3 years? Blockchain, Bitcoin, etc. Who understands any of that? No one does. If you go to the average Canadian, they don't understand it, but they invested it, and no one's stopping them. Meanwhile, I go to a bank and I want to borrow, invest in firm capital. Oh, it's risk rated, high. Can't give it to you. You're in portfolio A. There's a problem, right? We pride ourselves that we haven't had a loan loss in 35 years, none. But yet, blockchain and Bitcoin are boxes that nobody can understand. How does that make any sense? But look, I had a conversation with somebody at Scotia a little while ago. Get this. Aurora Cannabis, which is covered by research, is risk-rated medium. Berkshire Hathaway is risk-rated high because it is not covered by research. There's a problem. That's a problem. So I can smoke weed, but I can't buy Coca-Cola indirectly by one of the best investors of all time. Like, makes no sense. So there has to be a real discussion around alternative investing. Look, people are living longer. They have more money. They have other ideas of investing. Why not open the space up for other buckets and allow for people to invest properly?
Because our primary, and it's the same with your equity issues, it's 95% retail and 5% institutional. So it's often older people, or often not old people, who want just an attractive yield. And trying to invest through your RSP,
It's terrible.
except for the three of us that are public,
Yeah.
is a nightmare. So if you have a private MIC, try getting your shareholders to go through a bank and
It's
invest through an
terrible.
RSP. It's almost impossible.
I can give you the three bank guys that'll help you out there, by the way. But I literally know 3 guys that'll do it.
Yeah.
But you're right, it's impossible to get on a platform.
Yeah, it's really challenging. I can say we're a private MIC, and we have really been putting up a big fight to get formally approved on platforms. Often banks will accept you for some of their larger brokers that they have on their platform, who I suppose are trusted to buy different alternative products. But it is quite a battle, and it really just does impact the end investor, because it gives them less options and makes them jump through so many different hoops to get a single transaction done that it can be quite frustrating for people.
Is
And
there,
have you been able to convince them to allow your shareholders to invest through RSPs?
So we have done a number of one-off transactions at 3 of the big 5 banks that they're called unsolicited, so it would be like a client requesting to
Right,
buy.
and it's only because that's a very important client of the bank.
Yeah.
Yes, and then one of the big 5 banks we actually have a pretty large relationship with, and they do a number of trades with us.
I just was wondering, are you seeing a consolidation of the private mix? Are they being consolidated or bought up by the larger players? Is that something that's happening?
So I haven't seen that happen yet. I've heard a lot of chatter about it. What I have seen is more institutional interest in the space, and the space has become more competitive over the past few years. So with that, I think it will be more challenging for some of the smaller players to compete. Whether it's an attractive M&A opportunity, I'm not sure, because the loans do turn over quite quickly. The duration of our book is 12 months. So really you're buying broker relationships and a team, and that might not be enticing for different players. So I know that some of the banks are expecting that and have built teams to prepare for some M&A in this space, but I actually haven't heard of any large transactions happening. I don't know if you're
I could see
seeing
it happening more in the single family area, your area, than in our area, because it's hard to get, I think it takes 10 years for someone to be a really good non-bank lending underwriter. And if somebody wants to sell their company to us, it's probably because it's a mess.
Yeah, I would concur. I mean, the reality is, Rob's absolutely correct. The reality is that if you're buying somebody's book, what are you buying at the end of the day? You're buying an equity raise, because at the end of the day, those mortgages burn off and become cash, assuming that they become cash. And why are they selling? I mean, short of a life issue, the reality is it's probably a bad book.
Any other questions for this panel on mortgage lending?
I can just ask.
Yeah,
a
sure.
Good question. So rates are rising, obviously. Have you already, what have you seen in your market and your lending now? Are you increasing your rates, and are your NIMs getting squeezed? What are you seeing?
Well, because we have quite a bit of loans that are prime plus based, we're getting the benefit of that.
Yep.
And, I mean, it's too early to know if there's going to be any change in the quality of of real estate. If you look at the first quarter in Toronto anyway, the resale market was pretty strong even in March, and the April numbers aren't out yet. I suspect they'll be weaker.
Yeah, we're actually starting to see more turn down business from the bank coming to us that we normally would have seen, particularly on the single family side. And we know, I just heard the other day that a lot of banks are starting the process of not renewing, both, not on the real estate side, but on the business related side, which only means it's a matter of time before the non-business, i.e. real estate market gets hit. So to answer to your question, Anthony, the reality is that we are seeing a spike. We are pricing accordingly. We are increasing rate. But yeah, that's pretty much it. Yeah, so we are pricing rate, increasing rate, no question about it.
The idea is for them to only stay with you for a year and then refinance with an A lender.
Correct.
Or a B lender.
Correct.
And if that becomes more difficult, then what happens?
Well, then we'll work with the borrower and deal with them accordingly. I mean, it's the best way to describe it. You know, I mean, look, I'm not going to deny we had more renewals in the last, call it 2 years than we did in the previous, number of years prior to that. So renewals are a real issue. There's no question about it.
That's
But
interesting, because we had 73% turnover in Toronto last year. So 3/4 of our book that we had on January 1st was gone on December 3rd.
Yeah, no, our
It
book.
was an exhausting year of
Yeah.
new loans and loans coming out.
So let me just backtrack. Our book did churn, but the amount of renewal activity did increase. I will say that. So.
Yeah, with renewals, what we do is just to prevent people taking equity out of their homes, to reduce the skin that they have in the game. Any renewal that comes in, we base the price of the underlying asset on the original purchase price if the purchase was within the last 18 months. So that helps us prevent someone taking advantage of the appreciation in value over the past year or so and pulling equity out.
Okay, great panel. Thank you all very much. That's great, thank you. Okay. We're going to have another break. We'll make it 15 minutes, and we'll be back in for 2 more panels and then cocktail hour. Hi, can everyone please come and take a seat? So I just want to introduce this panel.